So I wanted to talk to you guys about the project, the upcoming presentation on Wednesday. I'm really looking forward to meeting everybody. I'm really looking forward to seeing your presentation and connecting about Canadian Pacific. You know what I was really excited about creating the research for Canadian Pacific because I think that it's a real company. It's a railroad company. It's been around for a long time. They they literally build the railroad from East Coast to West Coast in the US and in Canada. This is the way that they used to transport everything in the 20th century and late 19th century. So it's a historic company, and development over the last couple of years really made this a really popular hedge fund name, a really popular Wall Street name. And I wanted to use it for our evaluation to really look and find out what's going on. And a big part of this is learning how to do financial statement analysis, which I know some of you guys already worked with the Penman book. And basically our course is a kind of the how to prepare for the CMA exam, which is the Certified Management Accounting exam, and financial statement analysis is sort of 20-30%. So that's why we're doing these reports. So I wanted to go over this piece with you guys and then to introduce the assignment. And I wanted to sort of show you guys how to work with this, with the links that I created here. I wanted to first go over the next report, the big report, the Zacks report, and then get into a quick study on modeling. So what I want you guys to do with Zacks in terms of the report is the first objective of our valuation is to come up with a DCF model, or your residual earnings model. So I know some of you guys know how to do that, some of you guys don't. So I know if you're struggling, I'm going to help you out a little bit today with giving you an example. So the first part of the report is to come up and understand, hey, this company looks like it's worth $32 billion. With a share price over here, what are they trading at? We have a 52-week high of 186, 52-week low of 115, 1-year return of 50%. We have a beta of 1.4. So this is sort of some of the grounding metrics of what's going on here. And our goal is to figure out, hey, should we buy this company? Is this company worth investing into? Right? So we're looking into that. And the first thing you want to do is do a DCF on the future cash flows, right? What's the value of any asset? It's the present value of future cash flows. So what are the future cash flows of Canadian Pacific? Right? So we have that here. This is why I gave you guys this Zacks report, because we have a consensus estimate on 2015 earnings of $6.5 billion. Now what you have to do is go ahead and use that in your DCF and just see where you fall out at. Look, 2015 on the year, we have, those are revenue estimates. Earnings per share is 9.86 for the year as an estimate. And now this is the big number. Projected EPS growth next 5 years is 19%. So we're saying EPS is growing at 19% a year here. And the first thing, in order to ground your analysis, you need to do a DCF model, figure out, first year 9.86, next year 11.5, next year 12.9, and then you discount that at whatever the risk of the capital of the company is, right? And you add all that stuff up, including the continuing value. Boom, you have your equity price as based on the current research. And I'm going to do a quick video about how to do just that in a little bit. But first, I want to tell you, this is just the first part. This is called financial theory. That's financial theory. That's just how to use the tools of valuation, right? It's not exactly anything to do yet with how to actually value the company. But if you have the tools, now what you want to do is challenge this number. Hey, 19, is that a real number? Is that not a real number? Because in reality, the valuation that you get, whether it's 150 a share or 120 a share or 250 a share, it really depends on how much do you think the company is worth. Because right now, the company is trading at 32 billion. And you want to figure out if the value of the company is 50 billion or 20 billion, whatever that is per share, we'll figure that out. But, what's the value of the company? And for that, we have to go back, look at some of the other files. I want to sort of go back to CP and what they're all about. And the idea is with CP is that they are a company that's transporting commodities. And what are the top commodities they're transporting? Coal, grain, and automotive. So it's mainly energy product and food product. So in a way, why has CP stock price gone up for like 50% in the last year? Because the demand for those commodities has increased dramatically. And essentially, being that they're the only transporter, they're the ones getting exposure. So listen, if we need to transport, before we needed to transport $1 trillion worth of grain, and in 20 years we're going to have to transport $2 trillion worth of grain, we're going to have to double the market cap of this company, because it's going to have to just do double the business. There are no other businesses that do this. So this is the fundamental analysis that I want you guys to look at in terms of CP on a more fundamental and economic level. Is that, hey, listen, is the 19%, is that percentage real? Is that too much? Is that too little? Let's look at the company revenues and let's see what those depend on, and start looking more at the economics and combine the economics with the financial theory, because then you could take a firm stance on whether you believe this company value is going to go up or down. So what I want to do now is, in the next video, I'm going to go over the actual DCF model, so you can see first just how to model out the current situation, so you can begin doing the economic work to change that.